Hey everybody, welcome to this free edition of our Trader User Group weekly roundup for the trading week ending July 29th, 2022. I'm Preston Brent. Thanks for tuning in. This week's theme, well, is the bear market over or do we have another low to go sometime before the end of the year or the remainder of this year anyway? Well, let's kind of take a look at where we've been and what I'm seeing in the charts here. Let's start off first with this past week. Obviously, everybody had a very strong week. I mean, that was out without any argument there. The markets finished higher. We had an outsized 75 basis point rate hike. Despite that, and despite the news that the economy contracted 90 basis points in Q2 GDP, in kind of a seminal moment of bad news is good news dynamic kind of coming back to the surface again, investors are basically saying that this lower terminal Fed fund rate after Q2 economic contraction is probably going to be more the norm. The Feds are going to be forced to not continue to hike as aggressively. So we're going to see the markets do much better and perform better as big money valuations take into account that the Feds are going to stop and reach a terminal rate sooner than later. Okay. Now, the month of July has been very favorable, clearly, for the bulls. I mean, the Dow was up just about 10% for the month. S&P was up 12.5%. NASDAQ up a whopping 16%. Keep in mind that when you're in a bear market, counter cyclical rallies, meaning bullish up in a otherwise down bear market, are usually very strong. I'll show you on the chart here in a minute. But that's kind of what we've got for the month of July as we kick off the month of August coming up next week. I'd also note that consumer sentiment is at all-time lows, at least since they started tracking the data in 1970. So you had a lot of people on one side of the boat, very bearish, sentiment very ugly, which kind of attributed to, well, let's start looking for rays of sunshine here and buy on any news. And that's kind of what we saw in the month of July. Okay. If we look at the Fed meeting, as I mentioned earlier, they did hike the rate 75 basis points this past Wednesday. And a lot of market participants seem to interpret Jerome Power Ranger Boom Boom Powell's comments as surprisingly dovish, even though we hinted at a 75 basis point rate hike was on the table for September. We don't have a meeting in August. So the next one's in September. So and then it was followed up by a negative 90 basis point contraction for Q2 GDP. Okay. And the consensus there was for an increase of 50 basis points. So that was missed by 1.4% miss from what we were expecting versus what we got. And since this was the second consecutive quarter of GDP contraction, that was kind of the widely accepted definition for an economic recession. But leave it to this administration to try and, just say, well, it's really not officially a recession until the National Economic Board says it's a recession. And they're always about another 3 to 4 months later. So, I don't really care whether you argue it, whether it's a recession or not. I look at it that way. We trade it that way. We trade price action that way. And I will note that when markets have identified that they are in a recession, that's when buying generally already starts, because that means the markets have been in a recession for at least a month or two already. Okay. So with all of that downbeat news this past week, the markets kind of seized on that. And as a sign, as I said, the Feds could slow or stop their interest rate hikes. So that kind of extended the rally through this week, through the end of the month. Okay. So his dovish, Boom Powell's dovish post FOMC meeting comments, the Treasury yield curve steepened a little bit. Okay. The year-end Fed terminal rate, which is the rate that they feel it neither is supportive or accommodative or detrimental to the markets, is now estimated at around 3.4%, okay, and 3.8% at the end of 2023. So with rates currently at 2.25% to 2.5%, that would imply about another 90 basis point rate hike over the next 3 meetings before the end of the year. Okay. Now I will remind you guys that Just about a month or so ago, the terminal rate was around 3.75%. So this terminal rate is coming down. And that's what the markets, the bond market, and everybody else is pricing in. But keep in mind, the bond market is also pricing in that we're going to slow down even more in 2023, which is going to force the Feds to actually start, if you can believe it, cutting rates by 25 basis points in Q1, Q2 timeframe. Really, it's kind of like the arsonist shows up, starts the fire, then they put it out, and then once the fire's out, they got nothing to do, so they go looking for a place where they can start a fire again. So that's kind of what we've got there, and why the markets are up strong as they are. The interest rate velocity is going, or the rate of change is going to dramatically drop. Now, I look at it, and a couple of bond professionals look at it, and one of the best out there, Ackman, looked at it and basically said, well, if you've got a terminal rate around, let's say 3.5%, but you got inflation at 9%, that's not a terminal rate. You need to get inflation up. Otherwise, you're still accommodative and you're going to extend inflation much longer than you should. So I think either the markets have the interpretation of Boom Boom Powell the wrong way, and he's going to have to take a dramatic shift, or the markets have the correct interpretation and inflation will fall off the table over the next 60 to 90 days, and then Boom Boom Powell gets it right. So it'll be real interesting to see how this plays itself out. Okay. If we come over and look at European markets, you can see European markets were all in the green. 3.10% for the stocks, FTSE up 2.02, CAC 43.73, DAX 1.74. And the FTSE actually moved into the green year to date, but pretty much everybody's in the red year to date, with the exception of the FTSE. Okay. And euro inflation came in above expectations, naturally hitting about 8.9% in July, up from 8.6% in June. So the headline inflation is generally driven by food and energy there. Nat gas over in Europe rose after Russia reduced the gas supplies to just 20% of capacity in their Nord Stream pipeline, Nord Stream 1 pipeline. And that caused also the IMF to reduce its outlook for European economic growth through the end of this year to just 2.6%. And they had a previous projection of 2.8. But then they lowered 2023 from 2.3 further down to 1.2. So Europe also stands a risk of, if they're not already, moving into a recession here very soon. Okay. So we've got a lot of this stuff hitting out. You can also see, if we look at the real yield in the U.S. in the upper right corner, it's a red, minus 4.14%. So when you subtract inflation and a very low interest rate, we are still accommodative. So who knows how this thing is going to play itself out. I've always said that after we had the COVID shutdown in 2020, which I did not agree with, we should have left things open. But we shut everything down. There's going to be unintended consequences. And then there's going to be consequences that people don't think about, or there's going to be some unusual correlations, i.e., we've got strong inflation, yet we have a very tight labor market. Unemployment is under 4%. So it's just really strange correlations here. So we'll see how it shakes itself out. Meanwhile, in the Asian markets, you can see Nikkei, China, Hang Seng, Hong Kong, all in the red year to date as well. Okay. Over in Japan, the yen strengthened off their 24-year lows out to the US dollar. And we did see the Japanese economy pick up a little bit, led mainly by private consumption, which, according to the Bank of Japan, it's going to continue to recover. All right. And their core consumer prices, which is typically a leading indicator of nationwide trends in Japan, rose 2.3%. So I think we'll see some support and some accommodation for the yen as possible long plays, if for those of you that are like currencies. And then, of course, in China, the real estate sector there, which is just probably going to eventually implode, did receive a little bit of a boost. There was a report out of Reuters that Beijing plans to set up a real estate fund of hundreds of billions of yuan to support the distressed developers over there. But I don't care how much money they put in there. That thing is just going to eventually die. I think, as I told our members, there's going to be very little contagion coming over to the U.S. near term for that. But it has the propensity to really cause some dramatic issues sometime in 2023. And then we've got U.S.-China tensions on a number of fronts. One, there are reports coming out that the SEC is putting down the hammer on Chinese listed stocks on U.S. exchanges. They can't accept any restrictions on its access to audit papers of these U.S. listed companies. China's probably going to say net or no in Chinese, and that's gonna risk being delisted. And then of course we got 5G Pelosi looking to fly over to Taiwan and raise some hell sometime this coming week, and China's already threatened, don't do it. So we got some tensions there in the with the Chinese and the U.S. So we'll see how that all shakes out. Meanwhile, let's go take a look at the markets and see what we got floating around right here. I'm going to switch the screen over. Let me get it over here to the E-mini S&P 500 futures. Let me just get this off my screen here, and it'll take a couple of seconds to come up on your screen here. So what you're seeing here is the S&P 500 E-mini futures. You can see off that low, we had a low on 17 June, and we were down about 24.32%. We're still in correction territory, but we're well off the lows. And you can see this move up. We've taken out some of these gaps in the market, some of these moves here, and you can see where we're sitting right now. Now, keep in mind, I told our members that this 236 fib node is going to be a hard resistance point. We're going to have the natural. We moved over 4,100. 42 is going to be a natural. And I basically said from 41 to 4,200 is going to be a long, wide, sticky area. The 200 EMA is sitting at 42.15 roughly, okay? Little over 4,200. And when you're in a bear market chart, meaning the 50 is below the 200, what you've got to do is you've got to understand that eventually the markets are going to challenge both the 50 and the 200. Typically in a challenge in a bear market chart, it fails the challenge and rolls back over several times before it can move above the 50 and then go to the 200 and challenge the 200. So we're going to see this challenge coming up here, I suspect, shortly. You can see the challenge right here. It failed. We're there for almost 2 weeks. So we've been below the 50, really going all the way back to early April, mid-April, right? And then we challenged the 50 here. We were kind of dancing around the devil here until we got into this week with the Feds. And then once the Feds came in, we moved over the 50, and that softening of the near neutral terminal rate, interest rate wise, was enough to kick into high gear the markets. And now away we go. I don't think the upside is going to be too much. I am of the belief that we're going to roll back over again sometime before the end of the year and then have an uglier dive sometime in 2023. Okay. But a lot of things have to, a lot of things can change by then, but that's kind of what the markets seem to be suggesting to me. If we look at NASDAQ, it moved up the most, about 16% off the lows, but the lows were down 33.98%, almost 34%. You can see here, same thing. We're coming up to challenge the 200 EMA. Understand that the PE ratios, the forward guidance for NASDAQ has been cut. One of the fourth largest cuts this year. Fourth largest cuts in history of valuations for tech outside of 2008, 2009 and the dot-com bubble. So the NASDAQ and tech companies were already very, very low. So it was very easy when we got Amazon and Microsoft and Apple and Google coming out with earnings. They had a very low bar, and most of them beat the bar. Meta didn't, but that's a whole different story there. I don't view some of those as growth companies now. They're more kind of value. But I like Microsoft and Amazon for their cloud business. Those things are on fire and looking at their earnings. But if you look at NASDAQ, I think we're going to run up a little bit and then run into some trouble. We're going to have a little bit of a dip. We may come back and test the 50 EMA again, and that'll be a moment of truth for the markets. If we look at the Dow, you're going to see the Dow also sat on the 50 EMA, and then when we got the Fed announced, it just moved all the way up. So the Fed announced really kind of cleared the trajectory for most markets to come up and dance around the 200 EMA, and that's kind of what I think we're going to see here. And of course, if we look at the Russell, small cap index. Let me just find it on here. Where are we? Here we go, right here. If we look at the Russell, you can see here the same thing. We tested the 50 EMA, but it would not go below it. And then on Wednesday, when we got that big bump, away we go. So all indexes are telling me the exact same thing, right? Where the momentum is to the upside, we're probably going to test the 200 EMA. We may have a few dips, but it'll be a buy the dip moment near term. And then we got to see how price reaction is on the 200 EMA. Okay. And of course, if we look at volatility, it's come down. It stayed above 20. We're still in the light colored red zone, but we've just slowly moved down, right? Slowly, volatility's been sucked out of the market. Now, are we going to stay over 20 or are we going to go back into the teens? A lot of that is going to determine where we finish up on the markets and just what kind of data comes out from an economic perspective. We still about, we're about 60% of the way through earnings, 55, 60%. So we still have a couple of big companies, but the mega cap, we got them out of the way. And those were basically, the bar was so low, they've done fairly well. So I'm not too concerned about that right now. And of course, if we look at treasuries, interest rates continue to move lower. Bond yields are continuing to move lower. The bond market itself is going higher. Interest rates go in the opposite direction. So we traded this all the way to the downside. It was a great trade for us. And now, of course, I said that I want to let it run up here before I'm willing to take it back down again. If we look at interest rates, and of course, if we look at the 10-year rate, you'll see the 10-year rate coming back down. Look at this. We're going to come down and probably test the 200 EMA. This was my original target for the 10-year, right around 3.3. We hit 3.48. And now interest rates are coming down. And again, rates are coming down even though the Feds are hiking the rates dramatically, because there's not a lot of confidence in the markets on a go-forward basis, especially next year. They believe the Feds are going to probably reach terminal velocity sooner than was originally anticipated. That's going to stop the rate hikes, and then they're going to be forced to have to cut the rates because the market's going to be a little bit worse than feared. So that's what's goosing the markets right now. Okay. Now that is a scenario that it will play out, and we will see how it plays out over the next 90 days, but that's kind of what the markets are setting up for right now. Okay. If we come down here and we look at the US dollar, well, the US dollar obviously is going to be down a little bit. Okay. It's going to come down, test the 50 EMA. I do like the euro. If the euro moves into a recession, you remember when a country is reported as being in a recession, that's when you want to buy, because typically there's a lag of about 90 days on a company or country being in a recession. So that means buyers should be stepping in. So that would be naturally net bullish the euro, net bearish the dollar. But this is why the dollar is peeling back a little bit, but not much. We did not have any divergence up here. So that suggests we got one more attempt at a rally before it gives it up. So that's a little bit about what I'm seeing in the dollar. And then, of course, if we come down here and we look at gold, gold had a couple of strong days. It's around 1782 right now. You can see these gaps just move up right off this down low here. It came down to 1678. It's going to be challenging this area here. I think it's going to roll back over a little bit, and then it's going to consolidate for a while. I think longer term, 2023, by the end of 2023, gold is going to be back up around 1900, closer to 2000. Because I think inflation is going to last a little bit longer than people think. The markets are not going to be in a strong growth mode. Hence, gold is going to be an interesting play against higher inflation for longer. But right now, as you guys know, I've been bearish gold on this move lower. Okay. Same thing with silver. All right. Silver is going to make a nice little move to the upside. Silver is an easier play than gold. It's a higher beta. I think silver is challenging the 50 EMA. It kind of leads gold to some extent. I think it's going to break out of here and move up into the lower 20s, 21, 22 over the next 60 days, and then probably roll and just ride sideways for a little bit. But again, like gold, I think silver will be higher by the end of 2023. Oil, I think it's going to be north of 100 for a while. It's probably going to work its way back up there. You can see how oil does not want to go below the 200 EMA. So we're stuck in this mode right here. The 200 EMA is flat. The 50 EMA is moving down. So we're going to get a little bit of a squeeze here. I think the opportunity is for oil to move up a little bit. And then, but again, we have a way to trade oil, which is it's an easier way to do it, and you can make money in it really nicely. That I review with our members. Day trading oil is a really tough game, and you only have about a 40% chance of success on day trading oil. Swing trading maybe about 45 or 50%, but the way we do it, our odds are about 75 to 80% success rate. So that's where oil is. Nat gas, as you guys know, I've been long nat gas most of the year. I think clearly up at this area here, as I was telling our members, this is a good area to just enter or pick up a couple of puts and just hold on to it. It's going to come back down a little bit, but it's going to chop around for a while. Okay. And then the ags, we've had a trade in ag for about 60 days. It's been a home run trade for us. And members, I'll go through that with you this coming weekly market watch on Sunday evening. All right, everybody, have a really great weekend. Members, I'll see you this Sunday night for our weekly market watch. Take care, folks. Ciao.